Lemonade is stepping into one of the biggest insurance categories out there, car insurance. This, now in addition to homeowners, renters, pet, and life, is a step towards closing the loop on an entire insurance offering. In this video, I'm going to talk about what this means, whether it can shoot the stock higher in the future, and feature some clips of CEO Daniel Schieber discussing the move. Let's go. Specifically, auto insurance is a contract between you and the insurance company that protects you against financial loss in the event of an accident or theft. In exchange for your paying of a premium, the insurance company agrees to pay your losses as outlined in your policy. Here's Daniel Schieber with CNBC on the subject.
Why enter auto insurance, which is dominated by some of the biggest players, legacy players like Geico, Progressive, Allstate? Where's the opportunity for you?
We do pet insurance, we do renters insurance, homeowners, etc. Car insurance is 70 times bigger than renters insurance, 70 times bigger than pet insurance. And we have customers today who are already spending over $1 billion on car insurance. They're just not spending it with Lemonade, not because they don't want to, but because we haven't been able to offer it to them yet. So there's tremendous pent-up demand. Our customers are already spending extensively on car insurance. We get asked for this product on a daily basis. We sell a lot of homeowners insurance. Customers want to bundle it with car insurance. So there's tremendous demand. As for the legacy providers, that's an interesting one. You know, you've got Geico and Progressive and other brands that are spending billions of dollars a year on brand building and have been doing so for close to a century. We're, of course, not in that game. We're not spending those kinds of sums. But there are dramatic changes happening in the car and mobility space, massive dislocations, once in a generation changes, that are actually putting some of the incumbents, I think, flat-footed going into this era of connected cars, connected devices. And there's so much transformation that is coming to this space that actually having done this for 70 years might be a disadvantage as opposed to coming in naturally, digitally native will give huge advantages to companies going forward.
The ARK thesis on Tesla. So ARK Invest, super bullish on the stock. And part of the thesis is that they can insure almost half of their own cars by 2025. Now, that's not necessarily what's going to happen, but is that a risk that some of the manufacturers themselves could provide direct insurance to consumers?
No doubt. You think about what's happening to cars. Tesla is a wonderful example of the connected car, the electric car, cars moving from being mechanical platforms to being computers on wheels. And that has profound impact on insurance. One question is, who insures what? You go to Phoenix today and you order a ride-sharing cab. Some of them will come without a driver. Who owns the car? Who owns the service? Who owns the insurance policy? The person who's driving it, there is no driver. So there's going to be massive dislocation in this entire sector. And the data implications are profound, and they aren't good for incumbent insurers. Tesla can do what you're saying because they have live data feeds from the device which tell them how much you're driving, whether you're driving in roads that are prone to accident or safe roads, whether you're driving carefully or irresponsibly. And all of the pricing of insurance until now has had to look at big groups of people on aggregate and price them on an average. As soon as you can break apart that average, that monolith, and price people using specific data to them, you have a massive advantage that incumbent insurers don't like. Because if you have a $30–40 billion business, as Geico does, as Progressive does, based on pricing to an average, you don't want to adopt these new technologies because suddenly you'd find that half of your customers have been overcharging and you have to reduce their premiums. That's no good. And the other charge you have to raise premiums for and lose them, and that's no good. So you see folks like Warren Buffett being really hesitant and dragging their feet about adopting these new technologies, really ultimately doing it kicking and screaming because this transformation does not favor legacy providers. In general, I think you're going to see car insurance shrink. Over the course of the next decade, if you're sitting on the board of directors of one of these big incumbents, it's pretty daunting because you're going to see the total pie shrink. Accidents are going to decline, car ownership may well decline, and in any event, some of those dollars are going to move to businesses insuring fleets like Uber-style kind of scenarios rather than individuals owning them. So for incumbents, that's a disadvantage. But when you're starting not with a $40 billion business and you're worried about it shrinking, but from zero, there's tremendous upside and a lot of cannibalization that you can do into other people's businesses by adopting these technologies just as this disruption takes place, as this dislocation hits this industry.
Are you happy now with the suite of products you have, the markets that you're in for the next few years at least, or are there other big markets like car insurance that you're going to be entering soon in the next year or so?
We're rounding out with car insurance the core components of a household's insurance product. So I have taken care of the major items, and these are 3 major launches in the space of just 12 months. So certainly we've been stretching ourselves to the limit to bring exciting new products to market. But I don't think we're going to rest on our laurels. This is a $5 trillion industry, and there are many products, customers, and countries that we are not tackling yet. So we will launch this, we will digest, and then we will look for the next thing that we can hunt down.
Is a huge issue for you, and I'm just wondering how a company that has to insure against all these climate disasters, snow, hurricanes, the Texas freeze, which was a huge issue for you last quarter, is thinking about fighting climate change and reducing its carbon footprint on its own?
It's a great question, and actually our industry has a lot to answer for. Whatever I'm insuring you against, investing in polluting industries is bound to be increasing your risk rather than reducing it. We see the effects of climate change, of pollution, on health, on life, on property. And the idea that the insurance companies will take premiums to protect you and then invest them in the very things that are causing those ills is really beyond comprehension. In addition, of course, we have our Give Back program. So some of our premiums go to charities like 350.org and other climate proponents that get supported by premiums as well.
Daniel Schieber, thank you for joining us. Stock's now up 9.6%. You've talked it higher through the course of the interview.
So yes, Lemonade's decision to offer car insurance is a big deal. As they often say, the insurance market is so large that taking any piece of it is meaningful. That said, Lemonade does need to put out a good product here. Given what I know about the company, I think there is a high likelihood of success in this area, given LMND's strong network effects and the time they have taken behind the scenes to make this happen. Ostensibly, a company only focused on making money and on the short term would try and get its car insurance together as fast as possible. However, Lemonade is not that sort of company. They want to make sure what they're putting out is meaningful and differentiable. What Lemonade is striving for is to attract younger generations with its ground-up digital approach and grow with them over time. The best way to do that is to offer every insurance product along the way. So this stock really is a long-term play. As for the stock price, it's been under extraordinary pressure these last few months, down more than 50% from highs. It caught some support around $80, and we'll have to see how the macro environment plays out over the next few months, but I think there is time to let the stock run a little. I don't see any huge catalysts in the near term. It's a young business with financials that need to come a long way. Ultimately though, as I see it, Lemonade is a future growth engine that could stand to be immensely profitable in the future as its customer base grows, its global rollout continues, and more people choose to bundle up all the insurance that Lemonade has to sell. So that'll do it for this video. LMND is a very small position in my portfolio, but one that I do want to grow over time as we get quarterly indications that the story Daniel Schieber is telling is coming true. What do you think about Lemonade? Are you buying or staying on the sidelines? I'd love to hear your thoughts. Until next time.